What if I told you that one man's obsession with a sugary redkin, a drink most financial advisors would dismiss as a consumer staple, turned into one of the greatest investments in stock market history? We're talking about Warren Buffett. And we're talking about Coca-Cola. A love story 35 years in the making. A bet that turned $1.3 billion into over $25 billion in paper gains, not counting the billions in dividends collected along the way. This is not just a story about a stock pick. This is a story about conviction, patience, brand power, and why the world's greatest investor still cracks open a cherry Coke at 9 in the morning. Let's get into it. To understand why Buffett's Coca-Cola bet was genius, you have to understand what was happening in 1988. The year before, 1987, Wall Street had just lived through Black Monday, the single largest one-day percentage crash in U.S. stock market history. The Dow dropped over 22% in a single day. Investors were shaken. Fear was everywhere. And while everyone else was running away from the market, Warren Buffett was quietly, methodically buying. Not some hot tech company. Not a flashy startup. He was buying Coca-Cola. Between 1988 and 1989, Berkshire Hathaway purchased approximately 400 million shares of Coca-Cola at an average price of around $3.25 per share, adjusted for splits. The total investment? Roughly $1.3 billion. That was a massive 35% of Berkshire's entire investment portfolio at the time. His partners thought he was being too concentrated. Too risky. Too bold. Buffett didn't care. He had done his homework. So why Coke? Why this company? Buffett has spoken about this many times, and his reasons are a masterclass in value investing. First, the moat. Buffett is obsessed with what he calls an economic moat, a durable competitive advantage that protects a business from competitors. Coca-Cola, he argued, had the widest moat in the world. Think about it. You cannot replicate the Coca-Cola brand. Not with billions of dollars. Not with the best marketing team on earth. The taste, the nostalgia, the redkin, it's baked into global culture in a way that's simply unrepeatable. Second, pricing power. Buffett loves businesses that can raise prices without losing customers. Coca-Cola is one of the best examples in history. A bottle of Coke cost 5 cents in 1900. Today it's well over $2. And people still buy it. That's pricing power. Third, global distribution. In 1988, Coca-Cola was already in over 160 countries. It had a distribution network that took decades to build. No competitor could just walk in and match that overnight. Fourth, capital-light business. Coke doesn't need to constantly reinvest massive amounts of capital to grow. It generates cash, enormous cash, and can return that to shareholders through dividends and buybacks. This is the kind of business Buffett dreams about. He famously said, "If you gave me $100 billion and said take away the soft drink leadership of Coca-Cola in the world, I'd give it back to you and say it can't be done." That's how impenetrable the moat felt to him. Now let's talk about the returns, because this is where the story gets truly extraordinary. Buffett's $1.3 billion investment has never been sold. Not in recessions. Not during the 2008 financial crisis. Not during COVID. Never. As of recent years, those 400 million shares are worth somewhere between $22 and $25 billion, depending on when you check the stock price. That's roughly a 20x return on the original investment. But here's the part most people overlook: the dividends. Coca-Cola is a dividend king, a company that has increased its dividend every single year for over 60 consecutive years. When Buffett first bought his stake, Berkshire was collecting about $88 million per year in dividends from Coke. Today, Berkshire collects approximately $736 million per year in dividends, from the same shares they bought back in 1988. That means Berkshire is now earning more than 56% of its original investment, every single year, just in dividends alone. This is what Buffett means when he talks about businesses that just keep giving. Part of what Buffett understood before most investors was that Coca-Cola wasn't just selling a drink. It was selling an emotion. Happiness. Refreshment. Togetherness. Christmas. The Olympics. Summertime. A Coke at the movies with your family. Coca-Cola's marketing is arguably the most emotionally sophisticated in business history. Their advertising doesn't just say, "Buy our product." It says, "This product is part of the best moments of your life." That kind of emotional brand equity is incalculable. And Buffett, who is famously humble and practical, got it intuitively. He understood that the product had something special, a psychological stickiness that transcended logic. He didn't just invest in the stock. He consumed the product. Every single day, Buffett reportedly drinks 5 cherry Cokes. He's joked that 1/4 of his calorie intake comes from Coca-Cola products. When your biggest investor is also your most loyal customer, you're probably doing something right. Now, to be fair, not everything about this story is rosy. Critics have pointed out that Buffett has missed the peak years of Coca-Cola's growth. In the early 2000s, health consciousness started shifting consumers away from sugary drinks. Soda volumes declined year after year. Pepsi diversified aggressively into snacks. Coke was slower to adapt. There have also been moments where Buffett himself admitted he could have bought more. During the early 1990s, when Coke's stock was climbing sharply, he chose not to add to his position, something he later called a mistake of omission. And from a health perspective, Buffett's personal endorsement of the brand has drawn criticism. He's a powerful figure, and publicly championing products with significant health implications isn't without controversy. But as an investment thesis? The critics have mostly been wrong. The stock has continued to reward long-term shareholders with steady growth and ever-rising dividends. So what's the takeaway from this 35-year love story? Lesson 1. Conviction matters more than diversification. When you find something truly great, you have to be bold enough to size up. Buffett put 35% of his portfolio into one stock. Most advisors would call that reckless. History calls it genius. Lesson 2. Buy businesses, not stocks. Buffett didn't buy a ticker symbol. He bought a business with a century-old brand, global reach, pricing power, and an unmatched moat. When you think like an owner, short-term price swings don't scare you. Lesson 3. Patience is a superpower. 35 years. No selling. No panic. Just collecting dividends and watching the value compound. Most people don't have the emotional discipline to do this, and that's exactly why most people don't get these kinds of results. Lesson 4. Invest in what you understand. Buffett didn't buy Coca-Cola because of complex models or algorithmic signals. He bought it because he understood the brand, the product, and the human psychology behind why people would keep buying it forever. Simple. Powerful. Timeless. Warren Buffett once said, "Time is the friend of the wonderful business, the enemy of the mediocre." Coca-Cola, for all its simplicity, for all its sugary, bubbly, red-canned glory, proved to be one of the most wonderful businesses ever built. And Buffett, with his patience and conviction, proved to be one of the most wonderful investors ever born. 35 years. Billions in dividends. Tens of billions in gains. All from a can of Coke. If you found this valuable, like, subscribe, and drop a comment below. What's your Warren Buffett-style investment? What's the one business you'd hold for 35 years? See you in the next one.